In this episode, we are going to talk about the most important concept in trading, market structure. Understanding trend and basic market structure is so much important that everything else is based upon it. So let's get into it. Before we go any further, it is very important that you understand what swing highs, swing lows, and liquidity are. If you do not understand those concepts clearly, go back to my channel and watch the videos on those first. Everything we are about to talk about is built on that foundation. Now looking at the PDF, if price is going to move higher or trend upward, it must create higher highs and higher lows. That is the only way an uptrend can exist. For example, price forms a low, then creates a high. Relative to that first low, we form a higher low. Relative to that previous high, we form a higher high. Then again, a higher low, then a higher high. That repeated sequence of higher highs and higher lows is what defines a bullish trend. Now, if price is going to trend lower, the same logic applies, but in reverse. We start with a high, then form a low. Relative to that high, we form a lower high, then a lower low, then another lower high, then another lower low. That repeated pattern of lower highs and lower lows defines a bearish trend. A change in trend happens when that sequence breaks. For example, in a bearish trend, we continue making lower lows and lower highs. At some point, we make a lower low but fail to continue lower. Instead, we displace upward and create a higher high. That is the first sign that structure may be shifting. Then if we form a higher low and continue upward with another higher high, that confirms the shift from bearish to bullish. That point where the lower high sequence is broken and we form a higher high is our market structure shift. The same idea applies in reverse when going from bullish to bearish. In a bullish trend, we form higher highs and higher lows. At some point, we create a lower low. That makes us question whether the trend is shifting, but the shift is only confirmed once we form a lower high and then displace below the previous low, continuing the sequence of lower lows and lower highs. That is where the market structure break occurs. Now here is the important part. You must always understand the higher time frame trend when analyzing lower time frame structure. On a lower time frame, you might see a higher high and higher low sequence, then suddenly a lower low forms. You might think the trend has shifted bearish. And yes, that is possible. But if the higher time frame is still bullish, that lower time frame move down could simply be a retracement before continuation higher. This is where many traders get trapped. They try to catch the very first short when they see a lower low on the lower time frame. Then price reverses, makes a new higher high in alignment with the higher time frame, and they get stopped out. That is why it is much easier and much higher probability to trade in alignment with the higher time frame trend instead of trying to catch every top or every bottom. Now let's hop into the charts and practice identifying highs and lows so you can train your eye to see this clearly in live price action. Now let's take a look at a bullish trend and the structure that forms within it. You can see price has been trending higher. We get displacement out of the previous range, creating a higher high relative to the prior high. Even before a clean swing high forms, we can already see that price has extended beyond the previous structure. Now as price continues, we eventually form a proper swing high. That confirms the higher high. If the trend is going to continue upward, what do we need next? We need a higher low relative to the previous low. So we let price retrace and see what happens. Price pulls back and forms a swing low that is clearly higher than the prior low. That gives us our higher low. Now for the trend to remain bullish, we need price to close above the previous swing high and create another higher high. As price pushes up and closes above that level, we get the next higher high. Again, we wait to see if a proper swing forms. It does. So now we have the sequence: higher high, higher low, higher high. If the trend is going to continue, we want to see another higher low relative to the previous one. Price pulls back, forms a swing low that is still higher than the prior swing low. That confirms the higher low. Then we look for continuation. Price pushes up again, breaks above the previous high, and forms another higher high. Once the swing confirms, the structure is intact. This process just keeps repeating. Higher high, higher low, higher high, higher low. That consistent sequence is what defines a bullish trend. It is nothing complicated. It is simply structure. As long as price keeps forming higher highs and higher lows, the trend remains bullish. Now let's hop into an example of a bearish trend so you can see the opposite structure in action. You can see price starts with aggressive displacement lower. That first strong pushdown sets the tone. After that move, we form a low. Now the next thing we want to see is a lower high relative to the previous high. Price pulls back, and we do get a lower high. That confirms the first part of bearish structure. Then price pushes down again and creates a lower low. Once that swing confirms, the sequence is clear. Lower high, lower low. From there, we want to see another lower high relative to the previous one. Price retraces upward, forms a swing, and that swing is still below the prior high. That gives us our next lower high. Then we continue down again, forming another lower low. The structure is intact. Again, we look for a lower high. Price retraces, forms a swing high, and that swing high is still below the previous lower high. Then price continues lower and creates another lower low. You can see the pattern repeating. Lower high, lower low, lower high, lower low. Now inside that structure, you may notice smaller highs and lows forming. Some of those internal highs and lows get swept before continuation. But the key point is that relative to the main structure, each high is still lower than the previous significant high, and each low is still lower than the previous significant low. That is what defines the bearish trend. And remember, not all examples are going to look this clean. In live markets, structure can be messy, but as long as the dominant swings are forming lower highs and lower lows, the trend remains bearish. Now let's hop into some real price action and just practice reading structure. Looking at this section of the chart, you can see that on the higher time frame we were trending bullish. That is our starting context. But zooming in, we begin to see some short-term bearish structure form. Price makes a high, then a low, then a lower high, and then a lower low. So on this internal structure, we are temporarily bearish. That lower low confirms short-term weakness. Now if that short-term bearish move is going to continue, we would expect to see another lower high and then another lower low. Price retraces into a fair value gap and forms what looks like a lower high. So we anticipate continuation lower. But instead of making a lower low, price forms a higher low. That is our first warning sign. Then price makes a higher high. However, notice that there is no strong displacement yet. It feels more like consolidation than a clean shift. So at this stage, we are cautious. We do not know whether price wants to fully shift bullish or continue lower. As price continues, we eventually get displacement and a strong close above the previous high. That confirms the higher high. Now, if we are going to shift bullish properly, we want to see a higher low followed by another higher high. Price pulls back and forms a higher low. Then it pushes up again and creates another higher high. That confirms the bullish shift. From here, price continues to retrace and expand, making higher highs and holding higher lows. Even when there is messy internal structure and small sweeps, the main swing low that matters has not been broken, so the overall structure remains bullish. Eventually, though, we see something important. Price breaks a significant swing low. That is where we begin to think about a potential shift to bearish. If we are truly shifting from bullish to bearish, we now want to see a lower high form and then a lower low. Price retraces and forms a swing high that is lower than the previous high. That gives us our lower high. Then price displaces and closes below the previous low. That creates a lower low. Now we have lower high, lower low. That confirms the bearish shift. From that point, if the bearish trend is going to continue, we want to see more lower highs and lower lows. And that is exactly what happens. Now here is the key lesson. Structure can look messy in real time. There will be sweeps, there will be internal highs and lows that get broken. But what matters most are the significant swing points and the displacement around them. The true shift in structure happens when the low that created the most recent higher high gets broken with displacement. That is the actual change in trend. Before that break, any move lower could just be a retracement or liquidity sweep in discount before continuation higher. So when you are reading price, always ask yourself, what is the higher time frame doing? What swing actually caused the new high? Has that swing been broken with displacement? That is how you identify real trend shifts instead of getting caught in every small pullback. All right, so that wraps up this section. If you really want to understand this, the best thing you can do is hop into your own charts and practice. Mark it up yourself, replay price, and study how structure forms and shifts in real time. That is the only way this will truly make sense. What we covered here is just the foundation. In the next video, we're going to move into advanced market structure and build on top of this. I hope to see you there. Have a good one.